Hello, welcome to It's Your Smarter Money with Dr. Laura and Professor Steve. Recently, we've been asked by a client if they should consider investing in an IPO. Now, with all the news around Robinhood and the drama behind that and the fact that they might be going public, IPOs seem to have become more of gaining more recognition. And in fact, in 2020, there were quite a few IPOs. I think it was a record number, somewhere almost near 500 companies did an initial public offering. Companies like Snowflake and DoorDash and Airbnb all were initial public offerings. Now, we may continue to see some of this IPO activity in 2021 as well, because the interest rates are low and there's additional spending and there's a lot of capital looking for places to go. And so the question is, should our clients consider investing in IPOs? We think, first of all, we need to explain exactly what an IPO is, right, Steve?
That's correct. It's
Okay.
an initial public offering. That's what IPO stands for. And it's actually a good thing that we're seeing IPOs. They're just not necessarily a good thing for an individual investor. The reason why it's good to see them is because the number of companies are actually listed was declining dramatically over the years. And so when companies issue these new initial public offerings, you actually have new companies on the stock market, which is a good thing. So we'd rather see that expand than contract. But so what is an IPO really? What does it really mean? It's a way for somebody who started a company, let's just say, or as an example, you start a company and you start it with an investment of, say, $10 million on your own, you have your own money, and you become relatively successful. And there's also possibly some buzz around the company, even though it's a private company at this point. But you think that, gee, something, maybe I can get more capital into my company to help me grow faster. And additionally, perhaps I can help make my ownership in a company more liquid and maybe diversify away from it a bit myself. So what you do is you go to an investment banking firm. I won't mention any names, but there's a lot of really large investment banking firms out there. And them, together with possibly other analysts, will say, gee, we think you can sell X amount of shares at $10 a share, argument's sake. And so that you could maybe raise a total amount of $200 million by selling shares in the company. And so what they'll do is they'll float this issue of stock on the market, and this is called the primary market, which Laura's going to probably explain a little bit more. And suddenly now you have a $200 million company, and you might have retained 30% or 40% of the ownership of the company. Suddenly your $10 million is now maybe worth $60 million. And you now have the ability to sell some of your shares and some of your ownership in a company, effectively allowing you to diversify away from just owning that company that you really work for.
So one of the things that Steve's talking about is the fact that the initial owner, you are the owner of this firm, and you're now selling the creation that you have spent hours pouring into, all of your time and money and effort, working on weekends and everything else. And now you are selling your company, a part of the ownership, to these strangers out there that are willing to invest in your company. And you want to get the top dollar. And the problem is that if you sell the company for an initial price, that just for argument's sake, I'm not sure if I was following all of Steve's numbers, but let's say for argument's sake, the company is $100 million company. I'll just call it $100 million for round numbers, and I sell 10% of my company on this initial public offering, and so now the people out there have $10 million worth of my company. I get $10 million. I'm happy, right? Until I find out that they went and turned around the following month and sold those shares on the secondary market, and they sold all those shares for $20 million. That is annoying to me, because basically what I did was I left money on the table. I didn't realize that my firm or my company was worth that portion of the company was worth 20 million. And so, and I don't get any of that. All
So
of
I want to mention on that, work on that a little bit, is that the initial offering price is typically determined by the investment banking firm, as I said, possibly your firm that you're part of, that you're selling. And together you try to decide what's the best price to offer these shares on the primary market at. And so look, it's guesswork, and it's hard to take into account the possibility that there's a lot of buzz around a company and the shares may immediately climb in value dramatically. It's very hard to estimate that. And there've been a number of cases which we're going to show where the shares did go up initially, but then went down. They plummeted in value.
it's all about valuation, right? And you know, especially in an environment where valuations seem to be a little bit distorted due to speculation, due to intangible assets, those kinds of things, it becomes even harder. So when we talk about this, we're really talking like, let's just bring it down to something that most of us are very, very comfortable with. Let's say I was a senior executive for Toyota. No. We're talking about Steve. Let's say I'm a senior executive for Chevrolet Corvette. And I'm selling Corvettes, and Steve comes to my my dealership and he buys a Corvette. Let's say he buys top of the line, $100,000 Corvette. And he leaves the showroom, and because this is a very, very special car, next month he gets to sell that Corvette because he decides he's looking at Maseratis. He likes cars. And so he's going to sell the Corvette for $110,000. Again, he's the one, when he sells it to his neighbor on the secondary market. He bought it from me in the primary market as the dealership, but now he's selling it to his neighbor on the secondary market. He gets to pocket that extra $10,000. I don't get, as the dealership, I don't get that money. I just got the initial money on the initial public offering, which is why this whole, how are we going to value our initial public offering is so hand-wringing. There's a lot of debate and discussion and conversation in the beginning about what should we offer the—
And a lot of number crunching too at the beginning as well. But I want to mention something real quick, in that they have a vested interest in trying to get the best price possible for their ownership, not necessarily valuing it at its true value. And that's an important issue here.
Absolutely. But so we're talking about the primary market versus the secondary market. When we go back to the concept of stocks, when we talk about the New York Stock Exchange, that's the secondary market. That's where when we go and you say, oh, by the way, I want to buy some Apple or whatever, that we're going to the stock exchanges to buy those investments, and they're all traded.
Secondary means that people trading the stock with each other. They're not buying it from the company as they did in the initial public offering.
Right. So what we've seen, should we invest in an IPO? Again, we're trying to unravel this. And the question is the company being priced at the right value? And what we have seen historically is that IPOs tend to have this kind of pattern, the same type of shape of returns, where initially the price actually goes even up. And for a couple of days, maybe a couple of months even, it could actually carry a higher price. But then it kind of settles off and it finds this equilibrium. And if it's a profitable company, it does eventually go up and everybody's happy. If it's not a profitable company, it can wind up going completely out of business. Steve, do you remember that company Petcom?
I do. Pets.com, I think it was, or pet.com. Yeah.
Our red line is pets.com.
Yeah, I remember it well. I remember the commercials. I think they had the hen puppets in the commercials, if I recall.
They did a commercial actually on the Super Bowl, and I think they invested like a crazy amount of money on that initial that one commercial, and they never recovered. But they are a perfect example of the red line. So again, this is the initial IPO where you get this kind of up and down movement. And what you're hoping is that you get, eventually the up movement. But we have two examples of that. And one very happy example
Yeah,
is.
and I just want to mention one thing real quick before we say this. We just want to really, what we're trying to highlight here is that this is not the best investment for most individual investors, and we're going to show you why.
Because you haven't done the full price discovery of what is the value of this company.
Yep.
When we talk about speculation, you know that Steve and I don't like speculation. We are investors. We're not gamblers. And especially when we're working as producers for clients, we're not going to speculate with your money. And we're just not. If you have money on the side that you could have taken to Las Vegas anyway, and you want to put it on red, then by all means, and I've helped clients do that in the past.
And I want to mention, there's a supply and demand factor here, is that many IPOs are oversubscribed, which means people are desperate to get be part of the IPO, and so they may be issuing a million shares where people want 2 million. So like any other supply and demand sort of thing, and it works the same as any other market. When the demand is much higher than the supply, the price goes up, and a lot of times it goes up without any value that really matches that price increase. So.
So this actually is a chart of Google, and Google wound up coming, they did an IPO back in August of 2004, and their initial price was $85 a share. And by the end of the day, it was trading for over $100 a share. And now it's trading for around over $2,000 a share.
This is a happy example.
This is a wonderful example. Google has done very, very well. And so if you invested in that, that you would have been very, very happy. This, on the other hand, a lot of people know Groupon and think that Groupon's a great company. And while it might be a good company, it hasn't had the same type of performance. In November of 2011, it came out of the gate with an IPO of $28 a share. Well, if you look at this chart, it actually went up. There was so much hype around this particular.
You can even see $20 a share on this chart.
Yeah, there was so much hype on this that by the end of the year in 2011, it was trading for somewhere around $400 a share. But then it settled off, and still, as of today, Steve just pulled this off of the Bloomberg terminal today. It's trading at somewhere, I think that's $38 a share.
Yeah.
That is trading at. And so, if you came in, and the problem is that if you were interested in the IPO, you probably did not get into it at the $28. Those were the initial institutional investors that got in on the $28. You probably came in somewhere in December, and or later November, December, and you probably paid something like $300 and $400 a share.
And the hype was still there. The hype existed yet.
And so you still have not recovered from that. And unfortunately, we see, we could put 10 more IPOs that had great performance and 10 more IPOs that didn't have such great performance. And, the problem is at the time of the IPO, there's just not enough information to really discern which are the ones that are going to outperform and which are the ones that are not.
Yeah, and like I mentioned earlier, you have to consider who's coming up with the initial public offering price. And there are people who don't have the investor's best interests at heart. The investment banking firm, their real goal is to get the most value for the existing owners of the company, and of course themselves, because they're earning commission.
Yeah. They make a lot of money by doing the underwriting for these.
A lot, millions, hundreds of millions in many cases.
That's why underwriters,
That's why they have a lot of very expensive offices with a lot of wood paneling.
Yeah. That's probably the largest revenue generator of their firms.
Yeah.
So what should you do really? We want you again to, just be able to discern, what is hype versus what is not hype, and really understand that it's probably best for us. So if you want to get involved in a company that has an initial public offering, we would suggest that you kind of wait a little bit of time. Let it find its value. Let it become crystal clear whether this is a profitable company or not. And you can get into it on the early side. You know, you could, with, for example, Google, you know, after you've seen the trend and where it's going, you don't have to necessarily get in at the rock bottom price. The rock bottom price is probably not where you want to get in.
Yep. And additionally, you never wanted to make it a large piece of your net worth or your portfolio. Just a tiny piece, if you really insist on doing it.
Right. This is less of an investment and more of a gamble.
Yeah, it's a crapshoot.
As always, we welcome any questions or thoughts that you have, especially if you want to talk individually to either one of us about your specific needs. We're always available for you, and we love to share this information. So thank you for joining us today.